Hello and welcome to Hedgeye NexGen, where we're going to break down finance in its simplest form to help you build wealth. I'm Ryan Ricci.
I'm Ben Perko.
And today we're just going to break down what drawdowns are, how they're going to impact you in your overall investing career. And
yeah, this is an interesting one. There's a lot of stuff I didn't know that you taught me about, so pretty pumped to bring this one to you guys. And yeah, should we just get right into it?
I think we should just get right into it. So I think the first thing that we have to break the myth of this is a drawdown does not equal a gain. So if you have a drawdown of 20% and you're up 20%, you're not broken even.
No. Which I'm sure a lot of people don't know. I did not know that.
I'm going to be honest, I don't think I knew that coming into this job. I learned that very quickly, though.
Yeah.
It's a little bit kind of like an exponential thing. So we have a chart, but I'm going to go through the numbers instead because most people are listening. So we got to talk through it.
Yep.
So if you lose 10% of your money in order to break even, you need to gain 11% to break even. Okay. If you lose 20% of your money, you need to gain 25% of have a 25% gain to break even. Okay. It only gets kind of exponential from there. Okay. If you lose 30% of your money, you need a gain of 43% to break even. Down 40%, a gain of 67%. A loss of 50%, you need a gain of 100%. A loss of 60%, you need a gain of 150%. If you lose 70% of your money, you need a gain of 233%. If you lose 80%, you need a gain of 400%. Okay, and if you lose 90% of your money, you need a 900% gain.
It's insane.
It is wild.
Yeah.
And it's honestly the biggest. It's really the biggest drawdown in your portfolio that you would ever see.
Yeah.
And it's one of the most important because in order to gain, let's say you lost 70%, you need 233% to get back to break even. There's a lot of time that it takes something to make that much money. So not only are you losing money, you're losing time. And especially if you're about to retire, imagine you lost to 70% and now you have another 6 years to work in order to retire.
Yeah.
That's awful.
Yeah.
That
and I'd say getting 233% is way harder. You could go down 70% depending on how you're allocated, in a week, very quickly. It's way harder to make those correct bets to get you back up that far.
Exactly. And what people almost always start to do once that this happens is they're down so much I need to get more risky.
Right. Yeah.
And then they lose.
They open themselves up to
Right. Because they're I need to get more risky to get myself back quicker. And then all of a sudden they start taking dumb bets and they lose more money.
Yeah.
It is so bad. But also just so we'll get into some more charts later on Bitcoin, but the 2021 crash, Bitcoin was more than a 70% drawdown. So people had to be up over 233% in order to get back.
Yeah. So we're not making this up. I mean, you can look at that.
Yeah, exactly.
Real life example.
Exactly. And a lot of people our age are a lot of Bitcoin.
Yeah.
Rightfully so. It does get a lot of returns. I get it.
Yeah.
But at the same time, you have to know this drawdown math and know what you're dealing with, because if you can avoid these, you can actually compound your growth like a machine.
Yeah.
So that's what we're going to get into in the rest of this episode is basically all these crashes and what your portfolio could look like if you literally just avoided them.
Yeah.
You don't have to be too much of a genius, but we're going to start off with some of the major market crashes. In September, so from September 1st of 2000 to October 9th of 2002, the market went down 27%. Okay, that was the first major crash.
Yeah.
The next one was October 9th to 2007 to March 9th of 2009. The market went down 57%.
Wow.
Yeah.
I mean, that's quick.
Yeah. A couple of years, but 57% is
that's a ton, and that's fast.
Yeah. Well, but Nasdaq went down more in the 2000 crash. That was a tech crash.
Yeah, the .com.
And the 07 crash was more like a financials type of crash.
Yeah.
Okay. October 2nd of 2018 to December 24th of 2018. That one was pretty quick. Market went down 20%.
Yep.
February 19th of 2020
yep.
to March 23rd of 2020, The market went down 34%.
Oh my
That
gosh.
was the COVID crash.
Yeah, I think we
Okay.
all remember that.
Yep.
That was crazy.
And then there was another crash in January 3rd of 2022 to October 12th of 2022.
Yep.
That was a 25% drawdown. So that was the most recent one.
Mhm.
Okay. So even with all of these, let's say you were invested in S&P 500 and you wore every one of these crashes, you just bought and hold back then, you would have a gain of 411% today.
Right.
Not bad.
Right.
Not bad. So if you invested $1,000, you'd have $5,110.
Yeah.
Okay, like
It's good.
okay, good return.
Yeah.
Right, and that's people's benchmark in life, right?
Right.
As we
The
discussed,
market.
as
is
we
the
discussed
benchmark.
last week, S&P 500, that's your benchmark.
Yeah.
Okay.
Yeah.
But let's say we avoided these drawdowns in our portfolio.
Mhm.
Okay. So Hedgeye didn't exist in 2000. So let's just say, but I tried to go through a lot of our like documents and see
Yeah.
when we were getting out and into different assets and overall stocks.
Mhm.
Hedgeye didn't exist in 2000. So let's just say you got all your money out in October 12th of 2000, so a little bit after the crash started. And then you got back in June 18th of 2003. And that's basically you basically like you got back in, you sold and you got back in 24% below where it originally was.
Yeah.
You avoided an extra little bit of a drawdown essentially. Okay.
Mhm.
Then let's also do the crash of 2008. So our company is actually founded on a crash. So
Yes.
2008
This crash.
Yeah, it was the 2008 crash. Basically, our boss, he was fired for being basically like 2 to 3
Too
weeks
early. Yeah.
at a hedge fund or wherever he was. Don't hate me for saying wherever, but it doesn't really matter.
Carlisle.
Right. Okay, there you go. And essentially, and then Hedgeye was born a little bit like during this market crash.
Yep.
Okay. So on July 31st of 2008, we were sending out notes to subscribers being 85% cash. Okay, so that's
Yep.
get the hell out. And then we'll say, let's say you got back in on equities. We put out a note, bullish equities, on March 9th, 2009. Basically, you avoided almost 50% drawdown
Yeah.
based on those two.
Yeah.
Pretty
insane. And that's tight around it too. Like
That was
that's
very
tight around
That
it.
was a very tight one.
Yeah.
So we'll use that. Let's say you got out of the S&P at that time and then back in.
Yep.
Let's go to the next one of 2020. Okay, on March 4th of 2020. And then is when you get out. And then
Yep.
when you got back in was March 16th of 2020. We were telling people to buy stocks.
Yep.
That was basically a 24% drawdown between those periods, like to get out and then get back in.
Yep.
And we'll do our last one.
2022.
2022. January 19th of 2022, we're warning people of a crash, or not really a crash, just to get out of stocks.
Yeah.
Wasn't looking good. And let's say we got back in on May 1st, of 2023. Just avoided a 7% drawdown there. But let's go to our charts to see how this looks. So your S&P 500 returns, right, as we just discussed, if you just were in the S&P 500 from June 1st of 1998 till today,
Yeah.
you'd have a 411% return, okay?
Mm-hmm.
Let's just say you just avoided the 2000 crash, okay? Just avoided that one, and then you ate the rest. Your return would go up to a 590% return, okay? So if that's $1,000,
Yeah.
you now have $6,900. Okay?
Yeah.
Which is pretty good.
Yeah.
If you just avoided the 2008 crash, and then but you wore the rest, you'd have a 930% return. Okay, if you had $1,000 there invested, you'd have $10,300. That's double what you would have if you just bought and hold the S&P 500 just by avoiding that
Double.
one drawdown.
Right.
Double.
Right. None of the other ones, just one.
It is one.
Double.
You double.
All you had to do was get out too. You didn't have to magically pick something that was gonna. You just had to get out.
You just had to
See
get out.
the signs and get out.
Get out. But then we'll talk maybe a little bit later about getting back in is also important.
Yeah.
Because cash
Yep.
kills.
Yep.
But yeah, so you'd have double the amount of money.
Yeah.
But let's just say you followed us and you got out on all of these.
Yes.
Okay. Your return would be 2,039%.
Yeah.
And so let's say, which is like way above everything else. Let's say
Way
you had
above.
$1,000, you'd have $21,395.
Oh boy.
That's double what you would have if you just avoided the 2008 crash. I believe 4x as much as if you just bought and held.
Yeah. Insane. It's actually insane. Without any magic, you're just getting out. You're just avoiding drawdown.
You're buying and holding S&P 500,
Yeah.
and you're avoiding a drawdown.
Yeah, nothing fancy. You're just in and out of it at the right time.
Just in and out at the right time.
Yeah.
It's like, it is the number, like, people think, which stocks do I have to be in, and all of that.
Like,
that does matter.
I wish I saw NVIDIA back in the 90s, like whatever, you
Yeah.
know, something. It's hard.
That does matter. Yeah, that could help, sure. But what's even more important than that is not being in for a large drawdown.
Yeah.
And
yeah.
so
Way more important.
I think it's way more important. And so
It's also more realistic.
I think it's also, way more realistic than picking the perfect stock.
Right.
And then putting your entire net worth.
And then riding it for 30 years.
And riding it
How
for
you gonna
30 years. And maybe it works out, maybe it doesn't.
Yeah. That's a huge gamble.
A massive gamble.
Rather than, to go all out, realize it was maybe a false something, whatever signal, you can just go right back in. And you haven't really lost that much. You just lost potential return, I guess, but you haven't really lost money.
Yeah, I would just err on the side of caution, right?
Yeah.
Like, it's better not to lose the money because it's harder to get that money back.
Yeah.
Yeah, I think absolutely. But what I did after that was I said, okay, what if we use these same time frames and we just did it for the Nasdaq?
Oh,
right.
Even more exciting.
Right. So Nasdaq is basically tech, which
more volatile,
more
return, more crash.
Exactly.
Yeah.
That's the thing with more volatile. You can have a larger crash.
Mm-hmm.
So we go to probably the third chart, but I have all the numbers written down here.
Boom.
Here it is. So if you just bought and held the Nasdaq since it was January 1st, 1998 till today, you would have a return of 1,412%. So basically, if you had $1,000, that would equal you had $15,129 at the end of it. Okay.
Mm-hmm.
If you just avoided the 2000 crash, okay, you would have a return of 2,821%. So your $1,000 would now be worth $29,210.
Yeah.
Double.
Yeah. Yeah.
Double right there.
Oh.
That's just one. Okay. If you avoided just the 08 crash, your return would be $3,718. So 3,718% would be your return.
Yeah.
If you had $1,000, it'd be $38,180.
Wow.
Okay. And finally, if you avoided all of the crashes, okay, your return would be 11,651%.
Wow.
Which is a return of basically on $1,000, you'd have $117,000 and $117,519.
Jeez. Just from holding an index and selling it a couple times.
Yeah.
Like
that's 1, 2, 3, 4, 5 trades.
Yeah.
Or I guess 10 because you're buying and then you're selling and then buying. So about 10 trades over your 22 years.
Yeah. Wow. Speechless.
Yeah.
I mean, it's crazy.
Right. It's like it's just, and now let's say we went to like NVIDIA. Mm-hmm. Let's just say we went to NVIDIA and we did the same thing. Mm-hmm. Yeah, the returns are going to be even higher, right?
Yeah, of course.
Because the whole point is understand what you're in, okay? Understand the risk involved in what you're in. And then, but understand that you need to avoid the drawdowns. You cannot buy, like buying and holding is good.
Yeah.
It does make returns, but what makes you even more returns is the fact that when you're getting and avoiding a drawdown.
Yeah, and that's our forte here. That's like what we're all about is helping you avoid those major downward events.
Preserve and protect your pile.
And
because everybody, you can work 60 to 80 hours a week, right?
Yeah.
It's really hard to make a lot of money, right? Yeah. And then you're budgeting on this.
Yeah.
You're trying to save for a house, kids' college tuition.
Yeah.
The last thing you want is to see your money go down in 20% value.
Yeah.
Because now you need 2 more years to do it. Like imagine
5% to get back to break even.
But it's
you're not
also
making money
that
whole time.
It's also about the time too. Like imagine like you're like trying to buy a house, right? And you get a 20% drawdown.
Yeah.
Now you have to wait 2 extra years.
Yeah, to get a house.
Yeah. So
that sucks.
Oh, it's gonna suck. Your wife's gonna hate you too. Okay, so the next thing I did was basically say, okay, during each one of these drawdowns, I said, how long would it have taken you to break even?
Right.
Okay, so during the 2000 crash,
oh my gosh,
it would have taken you 2 years and 8 months to get all your money back.
Whoa.
Okay, the '08 crash, it would have taken you 5 years and 6 months to get all of your money back.
And that's just getting your money back.
It's just getting money back, breaking even.
Yeah.
Okay. 2018, it would have taken 7 months.
Yeah.
That was bad. 2020 would have taken 6 months.
Yeah.
The 2022 would have taken you 2 years. So, I mean, waiting 2 years.
You're just stunting your growth.
You're
like
stunting
5
your
years.
Exactly.
By simply just buying and holding on the way down for a big drawdown, which, it just takes a few trades over your career, basically, to like make or break.
Yeah.
Which is a little bit daunting, but that's why places like Hedgeye are here, right? Like we just went through the track record of warning people to get out ahead of these major downward trends.
Yeah. I would almost say like the most important people are almost those people that tell you to get out and those people that tell you to get back in.
Mm-hmm. Yeah.
Because the most important is to get out.
Yeah.
Okay. We've actually successfully called every major market crash.
Yeah.
Okay. So that right there is a pretty great track record.
Mm-hmm.
And now the next part is the next important person is telling you to get back in, which we go both ways.
Mm-hmm.
The person that's going to kill you is somebody who's always bearish.
Yep.
Right. Because like market goes up naturally.
You don't want to miss out on that.
You don't want to miss out on
at
it.
all.
And then the person, so that's somebody who's always bearish. And then somebody who's always bullish is, again, you're just accepting the market returns.
Drawdowns, yeah.
And you're accepting the drawdowns, of which you're actually hurting your growth, like a good amount, I would say.
A good amount over where you could be without it, yeah. I mean, it's still fine. You're like matching it. Yeah, you're okay, like sort of, but it'd be better to
you can make a little bit more money, almost double your money if you just get one of them right.
Exactly.
So I actually have a nice chart here for Bitcoin people.
Oh.
Yeah. I'm sorry, Bitcoin people, but this is really for you.
Look at this.
Okay, so from 2021 to 2022, Bitcoin lost 70%, had a drawdown of 77%. Okay? That means you needed to be up 333% from there in order to break even. Okay? That was it took you 2 years and 4 months of Bitcoin to break even. Okay? Let's just say we got out using Bitcoin, or our Bitcoin, like when Hedgeye's Bitcoin tracker, it went bearish.
Yeah.
It went bearish on 12/31/2021. Mm-hmm. And the next time it got bullish was 10/24/2023. Mm-hmm. Let's check the returns here. If you just followed that, you would have a return of 680%. Okay? Versus a hodling, so you just buy and hold, that return would have been 455%. Okay, so just for in terms of the $1,000 for the hodl, so a return of 455%. If you invested $1,000, you have $5,553.
Yeah.
If you avoid that 2021 drawdown, you'd have the return of 681%. Mm-hmm. You'd have $7,806.
Yeah, I mean, that's better. And that's in Bitcoin, where you don't know if you'll ever make back that 300% that you need. Like if you believe in it, yeah, sure, but you'd have to like take your money elsewhere. Like it just is so hard.
It's extremely hard, I would say. But I mean, just staring down, you need to make back 333%. Like that's significant.
Yeah,
losing 77% of your money, that's a lot. And so, but like, what Bitcoin people will always say is that, like, yeah, but like, it has those types of returns. Mm-hmm. Okay, that's great. Why not just avoid the drawdown and get it on the way up?
Seriously. Yeah, makes sense to me.
Right, because like, I just see so many people our age have like 50% of their worth in Bitcoin. Mm-hmm. You have a 77% drawdown, a 50% of your worth. I mean...
And that goes back to our last episode, why it's so important to diversify.
Yes.
Your risk profile, because if say you are caught up in one of these, you're not totally screwed. Like yes. In the Bitcoin instance, at least, right. Hopefully the rest of it is.
Right. I would say this is like the more risk you have in your portfolio, the more susceptible you are to a drawdown.
Yeah.
The more susceptible you are to a drawdown, the more you need to pay attention.
Yeah.
Right? Because it can go down, and it can go down a lot. And it can go down very fast.
Yeah. Okay?
So all that means is you need that. Like, if you're at 50% Bitcoin, one, I'm going to say you're dumb. But two, I mean, I'm pretty crazy too. But like everybody likes their their stuff. But
Yeah.
but you need to pay attention. Like you need to know, like you gotta be watching drawdown calls. You gotta be eyes on it. Like
You gotta know that price.
You gotta know that price. You gotta be like dialed
in. 24/7 market as well.
Yes.
So
exactly.
you can't sleep really.
And that's
the
not
entire time you hold it.
never sleeping. No, but like the point is like just know what you're in.
Yeah.
Understand Bitcoin's the most volatile thing out there. I understand it has the best returns, but like you really have to pay attention to these drawdowns because you could set yourself up very well. You just avoid one of them.
Yep. Yeah, and you could really handicap yourself if you don't.
And exactly, you can handicap yourself a lot. So that was really big. I think we talked about. I was going to say like the most important things in life.
Life lesson.
Yeah, I was going to life lesson here. I was going to, so after your wife, I think we talked about this. So after your wife, most important, okay, or husband, significant other, it was people that call the drawdowns and the people that get you back in. Those are the two most important, right? Because the Bitcoin people are right, it has the best return. So if somebody's always bearish on it, you are going to miss those returns, and that's bad.
And that's the whole point of being in it.
That's the whole point of being in it.
You know,
exactly, because holding cash, having nothing invested kills you, right? Because right, we just go back to our first episode, or maybe it's the second episode, right? M2, that's the real inflation in the economy.
Yep,
that grows about 7% a year.
Yeah,
okay. S&P 500 grows about 10% a year. Cash grows 0%.
right. So you're losing money the longer you're in cash when things are going up. You're literally losing.
So you have to do that get back in.
Yeah,
aspect of it. But it's an amazing thing when things are going bad. Okay.
Yeah.
But if you're holding it for like an extended duration, it's not good.
No,
it's not a good part of your portfolio at all. And so, I'm going to this next side here. So I basically have like 5 keys almost.
Here we go. The 5 keys with Ricci.
I'm going 5 keys today.
Okay.
It just kind of came to me.
Okay.
But here we go. I'm going to go. Number 1 is budgeting.
Yes.
Okay.
Yeah.
And that goes back to our first episode. You budget so that you can invest as much as possible.
Yeah.
It helps you invest more. So watch our first episode on why you need to invest as much as possible.
As much as you absolutely can.
Yes.
We talked about this for a while.
Yeah, exactly. So go back to the first one. That I think 2 is understand what you're invested in.
Yeah.
Right? That's the second episode we've done so far, right? Because if you understand what you're invested in, you understand how much time you need. And right, if you're into something that's more risky, like we just said, you need to pay more attention to it. And you
100%.
have to be a lot more into the market and understanding it, where the less riskier, you can sit back a little bit because you're probably not going to see those as big of drawdowns.
You can relax a little, but you may not get those upward moves.
Exactly.
Yeah.
So
which is okay.
It's up to the person.
To you.
It's literally up to
That's
the person.
why they all exist, right?
That's why you understand what you're in. So you can put yourself where you want to be. Well, number 2 is avoid drawdowns, and number 3 is avoid drawdowns. Number 4 is get your ass back in.
Yes.
That's what we just did this week. And the last one we'll get to next week, which is patience. And I put that one in all caps. And that has to have to do with compounding.
Yeah. Yeah, it takes time. You can get rich overnight, sure, maybe one person on the planet, but probably not you. So patience.
Well, it's probably not you. It's just that it's like...
It's an insane play.
No,
to try.
It is an insane play, but it's more that like... So everybody wants $1 million, right?
Yes.
That's kind of like the thing in all of our heads is $1 million. But the first million is the hardest million.
Yep.
And that one takes the most amount of time because when you're compounding, it depends on how big your pile starts.
Yeah.
For a lot of us, that pile starts at 0.
Yeah.
Right. And so in order to you continuously put money in, that's when the compounding starts, and then you're growing your base. When you're growing that, it's just that like when you get a 10% return on $1,000, I believe you're only we're going to do this. $1,000. I wish I was
$100.
Yeah, I think it's just $100. Yeah, it's $100. So 10% return on $1,000 is $100.
Yeah.
10% return on $1 million.
$100,000.
It's 100,000.
Yeah.
Yeah, that's right.
Yeah. So once you get more in the pile, you just make more on autopilot, basically, and that's going to be the whole key of the next episode is how to do that, how to start your pile, how to grow it,
Exactly.
how long to look out,
Exactly. Because
your time horizon.
Exactly. It takes a long time.
Yeah.
I think that, and it's this discipline of always putting your money in.
It's about process.
And eventually, you're going to make the first $1 million. And then guess what? The second $1 million, $3 million, $4 million.
It's going to be easy.
It comes
Butter.
like this because it's, again, like you're just on a 10%, which what the S&P 500 goes up, you made $100,000.
Yeah.
Right. So it's just, so that's what we'll get into next episode.
Yeah.
Okay. And then I think we should just talk a little bit more about like buying and holding.
Yes.
Okay.
100%.
So buying and holding.
That's what everyone says.
The HODL.
Yep. Hold on for dear life.
Hold on for dear life. I had a friend when we were backpacking in Iceland. Basically, it's a crazy story, but essentially we're going up this. Basically, it was a storm. We were the last people going up in 3 hours.
I love this story.
We're 3 hours from any civilization. Like a bus dropped you off and whatever.
Oh God.
And so we're backpacking. We're the last ones to go up, and we're just hiking in a literal storm. Like massive winds, all that. Anyway, trails are pretty muddy at this point, and we had to go up and around this bend. And so the first two people in the group go. Also, I'm leading. Why?
You're leading?
Me to lead. Oh yeah.
Oh boy.
I was the one that brought them onto this trip because I love backpacking.
Follow me, guys.
Oh, I planned the whole thing. All they had to do was show up. Anyway, two guys get up there. The last guy, he's like 6'5", massive. But basically, he gets halfway in around the hill, and he stops, and then he lays down. Ooh. But then the worst part is like at the bottom, it's basically like we're hiking a volcano because it's Iceland. It's like this like pool with like sulfur coming out because it's a volcano.
It's a volcano.
So like
literally, you're on a volcano.
So like if you fell, like it wouldn't have been that great.
Not have been good.
Anyway, he was holding on for dear life, and we don't want people to be in that situation.
No, you want to feel comfortable. You don't want to feel the need to hold on for dear life.
Yeah, exactly. But long story short, I basically I got down next to him because I was like, fuck, how am I going to? I got down next to him. I took his backpack off, put it on me.
Nice.
And then he was funny because he tried to actually push me out of the way to go up. I was like, fuck,
no.
Come on. I went up first and then he followed me.
There you go.
And he got up.
Showed him the way.
Yeah, and now he's alive and well, and he loves that trip.
Exactly.
See, that's why we don't hold on for dear life.
That is exactly why.
But anyway, I like to leave.
What a nice anecdote.
No, great anecdote. But okay, so buying and holding is kind of like easy. I get why people say, right?
It's the least effort.
It's the least effort. But I honestly think it's I think it's lazy.
It's definitely lazy.
Okay, wait. I honestly think it's lazy because let's just think about this. It's like an excuse for Wall Street. Okay. And that's ultimately what it is. And so it's an excuse for Wall Street to not do their job because they're basically like, oh, you can just buy and hold. Nobody can time the market. Nobody can do this. So you just buy and hold and you'll be fine.
Yeah.
Therefore, just give us all your money. We'll buy and hold for you.
Yeah.
And guess what? If there's a drawdown, we're not responsible because, well, everybody had a drawdown. Oops, sorry. No, that's your problem.
Right.
You have to hold on to this loss for the next 2+ years of your life.
Right.
And that's not going to be good.
No, it's not going to be good for you. They'll be just fine.
Right?
They'll be just fine.
Like your job on Wall Street is to avoid these drawdowns.
Yeah. The whole point.
And they basically never have to pay the consequences. You're the one paying the consequences.
Yeah.
Okay. So buying and holding, anybody's do you just need to buy and hold? Just look at them and be like, you're no.
Yeah.
No. Right. You need to find people in this, if you're going to be right, because people are now, they don't want a drawdown. So they need to go out and they're going to want to find people that avoid drawdowns.
Yeah.
I'll raise our hand. We're very good at it. Okay.
Yes. Proven to be very
It is
good.
very proven to be there, right? But that's because we're not lazy people, right? And we're responsible for our things.
Yeah.
Right? So you find those people that are really good at avoiding the drawdowns. Find the people that are really good at getting back in, right? We go both ways. And that's where you should be listening.
Yeah.
But listen to when they're talking about drawdowns. that's the most important part. Like,
Yeah.
if you're calling a quad 4 major market crash, your ears should be percolating, especially if you hold 80% of your thing in Bitcoin
Oh my gosh.
or something else.
Yeah, you should get out.
You should get the hell out.
Yeah.
And we're like, but it's bullet bearish trend. Okay. So like, I think that's the whole thing is like buying and holding is like the easy way out.
Yep.
Will it work? Sure. You'll get a return. Could you double your return if you literally just listen to us or anybody once? Yeah.
Yeah.
I'd rather see people be the bigger line than the lower line.
Yeah.
And avoid those drawdowns.
Well, and again, it's attainable. It's realistic. It's probably the simplest thing you can do without, trying to find some magic company 20 years before it blows up, right? Like, this is just indexes, avoiding like broad economic crashes, which, they encompass everything, even your single stock that you own. So you'd still be having to climb out
exactly
through that. So, it's to us, it's simple, it's realistic. It takes a little bit of effort, but that's why you got people like us that look at it every single day.
Yeah.
Like, we're on top of it. Yeah. And that's how it's done. That's how you do it, like the pros, better than the pros.
Yeah, you would be
in
better
some
than
instances.
the pros because, right, if most of the pros can't be the SB 500, all of a sudden you missed one of the drawdowns. Now you're all of a sudden beating the S&P 500.
Right.
Now all of a sudden you're doing better than 80% of the pros.
Yeah. Insane. Because they don't care at the same level because it's not their money.
It's not their
trading
money.
Other people's money.
But also some people are not good at calling drawdowns.
That too.
Right?
That too.
But it should be so important to you, like when you're looking to build wealth. Because also let's talk about like a little bit, but not a lot. Like finance is pretty important to like a relationship, right? Like if you just look at divorce, it's top 3 reason. It's finances. People don't have enough money. It creates all these friction, fighting, and all that, right? You don't have money to pay the bills.
Can't support someone who trusted you, right?
Exactly. So like, finances are a life thing too. So.
I mean, it's probably one of the, as much as people like to say how money is and everything, it's something. It's definitely something. And learning these skills are certainly life skills. Yeah, absolutely. So it's just something to be aware of, pay attention to,
exactly.
Do your research on, and now you are aware that a 20% drawdown is 25% to get back to break even, which I'm sure you didn't know before.
And that could take 2 years,
right,
for your life,
right.
So, you have any questions? That was my big.
No, I think you kind of nailed it. I mean, that's informative. I mean, like I said, I didn't know about that break-even point, so that's like pretty cool. It's really interesting. It's a really good thing that everybody should be aware of.
And it gets worse as you get like bigger drawdowns.
Yeah, almost exponentially. So I think I'm excited for next episode. That's going to be a really good one.
Yeah, I think compound will be good because it'll show the discipline needed. I don't think a lot of people do the compounding exercise to the fullest extent, but we will obviously
break it all down.
You know what? We're going to follow our intro. We're going to break it down to the simplest form.
Yep.
To help you make money.
There it is.
But anyway, everybody, thank you for joining us. We'll be back. We're doing these every other week. And thank you.